All right, so welcome to the next module, which includes chapters 5 and 6. Um, Up until this point, we've been learning about service businesses, right? You do work for someone to prepare their taxes, do housework for them, fix their car, what have you, but it's all service related. This particular chapter begins with an understanding of merchandising operation, which these are businesses that sell goods. Goods are physical products. And you've been to a ton of them already. I'm not every time you go to the mall, you're probably walking in and out of all different types of stores. And all of those are merchandising operations. They sell goods to you. The biggest one, Walmart, sells a whole mess of goods, about a $500 billion of goods every year at this point. So they're a massive operation. But as such, merchandising companies work differently than service businesses. They have a little bit of a difference. So we're going to be focused on that today. We also need to know, too, that their income statement is a little different. Okay, it still looks like an income statement, but there's just some extra categories that you're going to be learning about in this chapter. So this is our what we're looking forward to chapter 5. Okay, so actually today we're going to learn a little bit about the merchandising operation business and dealing with inventory. And then we're going to look at a business to business transaction, one business selling goods to another business. And we're going to stop there for today. All right, so learning objective 1. Merchandisers are in the business of buying and selling goods. And again, you've been and dealt with some of these companies already. I'd be surprised if you haven't walked into a Walmart at one point in time in your life. A lot of you deal with Amazon. I do as well. The book highlights another company, REI, Recreational Equipment Incorporated. It's sort of like Dick's Sporting Goods and a little bit like Cabela's in a way. So it's sort of a mix, but it is for outdoor activities or overwhelmingly. And they again sell goods. So again, goods, physical products. Now, one of the things that's interesting and we look down here, one of the things that's interesting is before you and I can actually go into a Walmart or sign into an Amazon to buy a good, these retailers have to have the good in stock. Okay, they actually have to own the good. And what they do, and I like this I think this needs to be changed. What I want to do is actually say that most retailers deal with manufacturers. Okay, and manufacturers, and I'll just does this make any sense? So anyway, manufacturers here basically are the businesses that make the products. They actually make the products. Walmart sort of changed it. It used to be that manufacturers were very, very large and retail firms were very reasonably small. There weren't a lot of big retailers when I was growing up, for example. There was Sears, there was Kmart, there were a few others. But there were lots more retailers that were smaller. So manufacturers make products, in large quantities. And because retailers were relatively small when I was growing up, it's hard for manufacturers to sell to the retailers. So they would sell to a wholesaler. Wholesalers would buy these in large quantities, and then the wholesaler would go and sell these quantities to retailers. And then, of course, the retailer would sell it to us. If you and I can walk into a store and buy something, it's a retailer. Okay, even if it has nice fancy names like BJ's Wholesale, Sam's Wholesale, it's retail. You and I can walk in and buy it. It's a retail store. Okay, the marketing is fantastic, but it's a retail store. It's a merchandise. Walmart changed everything because Walmart started to really get larger and larger. Particularly, it started growing in the 70s and 80s, very, very rapidly. And by the time the early 90s had started, Walmart was dealing directly with the manufacturers to sell to their retail store. They didn't need any wholesalers. They didn't need a middleman, so to speak. They could deal directly with the manufacturers, and they did. And so, because Walmart was buying such large quantities, because they had such large stores, they didn't need a wholesaler. They just could buy directly large quantities from the manufacturer, and thus they could sell it to us. So that's basically the process of the purchase and sale of goods. Manufacturers have to make the goods. The retailers have to buy from the manufacturer. When they buy from the manufacturer, there's a cost to that. So they have to actually purchase the goods first and put it in the store. And then they sell to us. Okay. They sell it to us as customers. What we pay, right? If you walk into a store and you look at any any piece of merchandise, there are prices on it. There's a price on it. What you and I pay for prices is the revenue for the retailer. So anytime you and I walk into any retail store, even if we just buy a bottle of water for $1, that's the sales revenue for the company. But remember, before they can actually sell you that product, they had to buy it first. They had to buy it first. So the sales revenue has to actually cover more than just your ordinary expenses that we learned about from Sierra Corporation, right, in the earlier chapters. It also has to cover the cost of what's called the inventory. When a company buys all these goods, okay, the term that's used is inventory. Right? And inventory, you've seen it before in the first few chapters. Inventory is an asset account. Okay, it's a current asset, in fact, inventory. And that's simply the retailer purchasing the goods and holding onto those goods in order to sell it to us, right? And so that's the inventory. The inventory has to be bought first, and that takes a lot of money. It takes a whole lot of money. Then they can sell it to us as customers. And so that's basically the system, how it works here. Okay, how it works. Like I said, the income statement is measured a little bit differently. Okay, we all know revenue minus expenses equals net income. We all know that. But for a merchandising company, companies that are selling goods, buying and selling goods, there's a little bit difference. First of all, their revenue account is called sales revenue. The word sales is equivalent to a product, okay, or a good. So when you walk into Walmart, you're buying goods and whatever products they have on the shelf. All of the revenue they collect is sales revenue. Okay. The first thing they do is they have to subtract out what it costs them to buy it and put it on the shelf. Now it starts off as inventory, it starts off as an asset account. But once they sell that inventory, it ends up as cost of goods sold. Cost of goods sold is an expense account. Okay, cost of goods sold is an expense account. And that's important to know. That's very important to know. The difference between the sales revenue, which is the prices you and I pay, and what they had to pay to put it in the store for us to walk in and buy it, is something called their gross profit. So the gross profit is simply the difference between the sales revenue and the cost of goods sold for the company. From the gross profit, all the other operating expenses are subtracted out. So all the other expenses that you've seen before on Sierra Corporation and other income statements from the first 4 chapters, those are all considered operating expenses. And then the rest, hopefully left over, is net income. So that's quite a long journey to travel from sales revenue, subtracting out the cost of goods sold, you get a gross profit. You subtract out all the other expenses the business has. They have rent, they have salaries and wages, they have interest expense, they have supplies expense, they have all types of expenses. And then the rest is net income. Um, One of the most curious things that people uh, need to realize too is in a service business, your salaries and wages expense is the largest expense because in a service business, you're paying someone to work for you. So for that business, paying the employees to do the job is the biggest expense. That's not true for merchandising companies. It's not true for any retailers. The biggest expense they have is the cost of their inventory that they sell. Okay. Salaries and wages expense would be here. But this not only is the very first expense they subtract out, but it's also the largest expense that they have. Okay. And so this is why Walmart's been very aggressive over the years, since the 80s, really, of bringing in goods from China that were manufactured in China because the cost of the inventory is so low. And again, cost of goods is an expense, and you want to keep all your expenses small because you want to make sure you have a profit at the end, right? And so this forces people, in essence, it's forced almost everybody in retail to do business with China. Matter of fact, Walmart, of all the goods that are imported to Walmart, 80% of those goods come from China. So Walmart has a very special relationship with China. China is the largest producer of electronics, for example, in the world. And guess what? Walmart's the largest seller, largest retailer of electronics in the world. China makes a whole bunch of clothes and other stuff, and Walmart sells a ton of that stuff. So it's sort of a match made in heaven in a business sense. Operating cycles are much longer for merchandising companies since there's more moving parts. In a service company, they simply perform the service, bill the client, and collect the cash. Real simple. Okay. Or even more simply, they perform the service and collect the cash. Woohoo, piece of cake. Merchandising companies are more complex in terms of its cycle. First of all, they have to buy the inventory. They're buying inventory from another business. So we're going to be looking at business to business transactions in this chapter, because in order for Walmart to get all the products in their store on the shelves, they have to order that from other businesses, the manufacturers specifically. So that's a business to business transaction that happens. That gets to be part of their inventory. Inventory is an asset. The whole purpose of inventory is to sell it. Okay, all merchandising companies are in the business of selling the products that they buy. And so that's they sell it. In most cases, if they sell it to us as customers, it's going to go right to cash. But if it's a business to business, say it's the manufacturer, they might extend credit terms, and so you might have an accounts receivable there. But it's just the process is much longer. It's a little bit more complex. Let me take a quick poll here. Those of you that are here, how many of you have worked retail before? Has anyone worked retail before?
I did.
Okay. Okay. A few folks out there. Thumbs up, and thank you for. Um, so you sort of know a little bit about the flow of how things go. Um, Inventory is everything to those stores, as you know, because that's the whole purpose of the retailer. So at the beginning of the accounting year, whether it's, and most retailers don't use the calendar year, they'll use a fiscal year. Um, And the fiscal years for most retailers start after Christmas because the Christmas shopping season is when they really sell much of their inventory, which means after Christmas, shopping season ends, which is usually in January, at some point, early January. There's very little inventory left in the store. So it starts off with counting what inventory is in the store. That's the beginning inventory. Of course, they don't want to keep their shelves empty. They want to keep buying more and more products, more and more inventory. So through the year, they are going to be purchasing more and more products and putting those on the shelf. Okay. So between the beginning inventory that they have and all of the goods that they are purchasing to put on their shelves, that's the total amount of money, the total amount of cost on those goods that are now available for sale. Now, the good news about inventory is this. From an accounting perspective, I'll reframe that. From an accounting perspective, the good news is only two things can happen to inventory. At the end of the period, it's still in the store, which means it's still your asset. It's still your ending inventory. If the merchandise or the goods is not there, we assume, that's a big assumption for some, we assume it's been sold, and so we expense it. Remember, cost of goods sold is an expense account. At inventory, I mean, if this is just beginning and ending, but really these words in essence are sort of clarifiers. Inventory is an asset account. You'll see it on your balance sheet, right? So it starts as an asset. Once it's sold, it becomes an expense. But the good news is only two things can happen to inventory once you buy it. If it's still sitting on the shelf, it's still your asset. If it's not on the shelf, we assume it's been sold and we expense it. Okay. Now, almost all the companies today are pretty large in retail, and they have a computerized inventory system. They use the barcodes on every product to keep track of things. So oftentimes when goods do come in, into the company, they usually start opening boxes and start scanning things in. That puts it into the inventory in your store. And thus, as customers go and purchase that, the inventory is always updated because every time you go and check out someone, you're either going to hear, a boop, boop, at the cash register, or you're going to scan it and it's going to show up. But either way, there's a continual record of how much inventory is in the store, and that's what a perpetual inventory system is. It's simply a inventory system that is continuously, that's the perpetual word there, as continuously updating itself. Okay, so as goods come in, we scan them in, and it adds to the inventory. When customers buy those, and they scanned at the register to show that they've been sold, there's a change to it's expensed, and the level of inventory changes as well. So today it's a highly sophisticated computer system that uses the barcode to help us manage inventory quite well. However, even though these records are perpetually or continually updated, at the end of a period of time, and it's usually a year, for large companies, they're going to do something called a periodic inventory, which is simply a physical count. If you've worked retail before, you probably got you got a list of products and the amount that the computer says we have in stock. And then you have this wonderful, wonderful job of literally going to each of those shelves and physically counting. Okay, so for example, you work at a CVS or other local pharmacy, and on your list of inventory that's printed out from the computer, it says you have 4 bottles of children chewable aspirin, berry flavor or whatever flavor it is. And so you're counting the bottles and you count 1, 2, 3, and there's really only 3 bottles that you count, but the computer system says on the paper you should have 4. Well, the 3 you counted, that physical inventory at the end of the period, is going to be the new inventory. The bottle that's not there for whatever reason is simply going to be expensed, regardless whether it, was stolen by a customer, stolen by an employee, misplaced, thrown out, whatever happened to that extra bottle, it's irrelevant from accounting perspective. We're simply going to expense it as cost of goods sold. So we do a periodic physical count, usually at the end of the year for large retailers. Some businesses count things more frequently. I mean, if you're at a Dunkin' Donuts, they're counting their cups and other stuff usually on a weekly basis to keep track of these types of things. That doesn't necessarily mean it's a be all end all, but they are literally performing sort of a periodic inventory, at least on whatever they're counting. For very, very small stores that are not computerized, they have to do a periodic inventory count periodically, monthly, quarterly, and yearly. So they'll probably be doing it every month because they have to put together their income statement. And again, the expenses on the income statement for a retailer include cost of goods sold. So again, all those expenses need to be appropriately updated. Okay. So, but thankfully, for the most part, most of our retail stores are quite large and electronically and continuously updated. But again, every now and then. Has anyone done a physical count? For those of you that worked on retail, has anyone done a physical count of stuff? How exciting was that? Probably not too exciting. Was it an overnight count? Sometimes they actually have, overnight type of stuff. Okay, great. Not saying anything, no problem. All right. So that's the two systems, perpetual and periodic. No need to worry about much of anything else. But so that's the introduction. Do it exercise 1-1 is simply a few statements that are true or false. And if it's false, how do you correct that statement? So here it looks very first one is the primary source of revenue for merchandising companies is to perform service. Well, no. Service companies perform services. Merchandising companies sell goods, so they have sales revenue. The operating cycle of a service company is shorter than that of a merchandise company. Yes, it is. Just less parts, less moving parts. Sales revenue minus the cost of goods sold equals the gross profit. Yes, this is something you have to know, by the way. It's one of the more important aspects that you'll be remembering for a long time. And here you have the ending inventory plus the cost of all those goods that you need to put on the shelf will equal all the goods available for sale. Well, no, it's not ending inventory, it's the beginning inventory plus all the new goods you buy is the cost of everything available for sale. Okay. So I'm going to go to the main screen for a moment and ask if there's any general questions or comments on that. So key point, like I said, is that there's a business to business transaction, right? Like I said, if you're looking at Walmart has to purchase those goods from another business to put it into their store. So any retailer does that. Okay. And I don't know what retailers you have all worked for, but it works the same way. That retailer is purchasing goods from usually a manufacturer these days. And those goods are being shipped to a distribution center and then shipped to the store. Okay. You're keeping track of all that inventory for sure, because inventory is the only reason they exist. The only reason you walk into a Dollar General is because the only reason they exist is to sell all the products on the shelf. They just don't have any other purpose other than selling the products on the shelf. That's retail. That's the purpose of it. So because inventory is so important, it's really sort of the focus of chapter 6. We introduced here in chapter 5. but it's really sort of the focus of the very next chapter. So what we're going to be doing now is we're going to be looking at a business-to-business transaction. Okay. Learning objective 2 and learning objective 3 looks at the exact same transaction, but one from the buyer side, they're buying the inventory. And the second is from the seller side, they've sold the inventory to another business. And so it's the same transaction, the same sale of goods, but now two different perspectives. Okay? Are y'all ready? Y'all don't look very excited. Okay. Need some more enthusiasm. Yeah. Ooh, ooh, ooh. A little bit of water. Okay. Never mind. Here we go. Okay. So what we've got going on here is these two objectives are based on this invoice. And I don't know how well you can read this, but part of the understanding of this next two objectives is to read the invoice. Okay. So just in general, it's a very open question. When you look at this invoice, can you tell who's the buyer and who's the seller? So this is a business-to-business transaction. We often call it B2B, B2B transaction, business to business. Who is the business that is the buyer? Who's the business that's the seller? It's an open question. Anybody can chime in. And it's just by looking at the invoice. Who's the buyer? Who's the seller? It's small print. I know. I'm sorry. All right. PW is the seller. Yes, that's correct. PW Audio, which is up here, right? They are the seller. The sold to is the big hint of who's the buyer. Sox, this is Sox Stereo, by the way. The company is Sox Stereo. So they are the buyer. And so what did Sox Stereo buy from PW Audio? Or what did PW Audio sell to Sox Stereo? Because the answer would be the same. It's on this invoice. Well, what they did is they bought, it looks like a circuit board prototype and some circuits, one circuit board and 5 circuits. Okay. The circuit board cost $2,300. The circuits were $1,500. So a total of $3,800 for the purchase and sale of these, of the circuit board and circuits. Okay. So for Sox Stereo, they're buying $3,800 worth of inventory. For PW Audio, they're selling $3,800 worth of inventory. That's important to understand as well. A couple of other things, 3 things that I want to point out on this invoice, other than the buyer and the seller and the amount of merchandise that was bought and sold here. The date is very important. You know, in accounting, everything goes by date, right? The very first thing you do in the journal is put the date. And so the date of this transaction is May the 4th, 2017. We don't really care about the salesperson, although the salesperson cares a lot about it because they probably work on commission, but we don't care at this point. 2 of the things we do care about are these last 2 boxes. One is the terms and the other is something called FOB, which I'll explain in a moment. So if this has terms, it means that PW Audio sold this to Sox Stereo and basically is waiting to get paid for this transaction. Okay, because PW Audio sold it, they're waiting to get paid. The terms are for Sox Stereo. Sox Stereo can do this. The first term, 2-10 or 2/10, means that if they pay this within 10 days of the date, they actually can take a 2% discount. In other words, they can pay 2% less of what's here. If they don't, so that's the 2/10. If they don't, they have to pay the net amount, which is the full amount, in 30 days. 30 days, again, from the day of the invoice. So the terms basically mean that this invoice for the sale of and the purchase of these products has not been paid for yet. And that sets up an interesting thing because for Sock Stereo, this invoice is a payable. They have to pay this. For PW Audio, this invoice is a receivable. They're waiting to receive payment on this. Same invoice, companies are looking at it differently. The last thing here is, again, this is about transfer of ownership. When is it no longer PW Audio's circuit board and circuits? And when does it become Sock Stereo's circuit board and circuits? So think of it this way. Excuse me, if you sold your car to your neighbor, well, right now your name is on the car. You are clearly the owner of the car. When does your neighbor really own the car, take ownership of the car? That's basically the same thing with merchandise. When one company buys merchandise from another company, when does the ownership transfer? Right. So clearly PW Audio owns this circuit board and these circuits because they're selling it to Sock Stereo. But when does the transfer of ownership go to Sock Stereo now that they bought it? Well, this is what the FOB box will tell us. FOB shipping point means that the exact same day that this is bought, this circuit board, these circuits are bought, and it's put in a box and given to the shipping company, then PW Audio has given up the ownership to Sock Stereo at the shipping point. Okay. And I'll show you this in another slide soon. The other one is called FOB destination, and that'll come on another slide. That's when these goods have to actually get to Sock Stereo's headquarters in Illinois for ownership to transfer. Okay, so two things here. That's a review of the invoice. It's a review of the invoice, and it's a business-to-business transaction. Learning Objective 2 looks at this from the buyer's perspective. So the very, very first thing we're going to be looking at in Learning Objective 2 is how does Sock Stereo do its accounting records for this? Learning Objective 3, we'll talk about how PW Audio does their books for this. Okay. So here we go. The first thing that we need to do if we are Sock Stereo, we bought this on the 4th of May, and it's going to be shipped the same day. So basically, we own it as the 4th of May. FOB shipping means it's going to be ours that same day here. Okay. And so what we're going to do is we are going to say that this is our inventory. But we have this invoice. This is a bill that we have to pay. We owe this money to PW Audio. So the offsetting credit will go to accounts payable. Okay. Now remember, this is the journal entry because everything in accounting, all the record keeping, starts in the journal. So everything that happens has the journal entry. The inventory account is an asset account, which is why the debit to the inventory account means Sock Stereo has more inventory. They now own this inventory. And the inventory, they bought it for $3,800. And so that is the value of the inventory coming in to Sock Stereo. They also have a bill. It's a bill that's due within 30 days. Terms are net 30, right? Which means that this is an accounts payable, and that's why the credit goes to accounts payable. All right, so when does ownership change? I alluded to this before. So anytime there's a business-to-business transaction, unless they're right next door to each other, there's going to be freight involved. There's going to be shipping costs involved. And shipping costs would also include insuring the packages to make sure that if anything does happen, that you have insurance to cover that loss. And I talked to you about FOB shipping point already, which is in this first box. So the seller boxes up the goods and gives it to the carrier company. Now, this could be the United States Postal Service, it could be UPS, could be DHL, could be FedEx, could be any of them. But at the point that this box is picked up by the carrier, the ownership has transferred to the buyer. And that's important to know because in our case here, the seller, PW Audio, is in Michigan, I believe. Let's go back. Yeah, they're in Michigan. And the buyer, Salk Stereo, is in Illinois. So it's going to take a little while for this product to get to the buyer. Okay. And because the buyer owns the product, as soon as it leaves the warehouse, it gets put on there. So the buyer is going to be paying for everything. The buyer is going to be paying for the shipping. Why? Because the buyer owns all these products at that point. This is the point where the buyer owns the goods, even though they're still in Michigan and they're waiting to get shipped, and it might take a few days to get delivered to Illinois. But that's how that works. The other option for ownership is FOB destination. And that means that the ownership transfers once the package gets to the buyer, okay, whatever address is. So in this case, again, the seller was in Michigan. The seller would still own all the merchandise until it literally got to the buyer's door. And then the buyer would own the merchandise at that time. So because the seller owns the inventory throughout this entire process, the seller is the seller's property. The seller is going to be paying all the freight costs, okay, because they own it. So that's really the difference between the two, okay. And you're going to learn a little bit about this in the next slide, I think. Yes. Okay. So here we have Salk Stereo is paying $150 to have the inventory shipped from Michigan to their company headquarters in Illinois. And it cost them $150. What do they put down on the record, on the accounting record? Well, you'd be a little surprised about this. But the way accounting looks at it is the inventory actually cost $150 more. And thus, based on way back in chapter 2, we looked at some of GAAP principles. One of them is a historical cost principle. And that means that assets are going to be recorded at the price we actually paid for them. So the way accounting looks at it is that the inventory is the amount that you spent on the inventory plus the purchase plus the shipping, because that actually increased your cost. So if you bought something for $10, but you actually paid $1 for shipping, the cost of the item is $11. That's how we look at it in accounting. Okay. So the freight costs or shipping costs are simply debited to inventory to show that the inventory costs more. And if we paid cash, we simply would credit cash for that. In the opposite, from if PW Audio paid the freight charges, in the case where it was FOB destination, then the freight charges would simply be an expense. And the expense is a new account. There's a new account you learn here. Freight out is simply an expense account. Freight out. It's when they pay for the expense. So it's the expense gets the debit, cash gets the credit. But that's only if the seller is paying for the shipping. That doesn't happen often. It does happen sometimes. It doesn't happen often. Well, you know the way it is. You probably have bought stuff online. You know, maybe it's at Amazon, maybe something else in a box arrives and you open it up and it's like, okay, this is good. This is good. You know, I don't really like this, or this is not the type of quality it should be, or you might even think it's damaged or defective. In which case you are dissatisfied. Okay. So what do? Well, most people return it. Same thing with businesses. When businesses get it, They look at it like, I'm not satisfied with this, I'm going to return it. So returns are quite frequent and common in merchandising transactions. Sometimes, and it doesn't happen often, but sometimes, like, well, this is not worth the price that I paid for these. So you sell hats and you just got a whole bunch of hats, for whatever purpose, whatever sport. And you're like, these are not really good quality hats. I can still sell them, but I can't sell them at a higher price. I'll keep them if you give me a discount on what I just bought for. Otherwise, they're going back. But I don't think. I mean, I think if you're a very respectable business person, and quality of products is very high on your list, you probably would just ship the whole thing back. You just simply return it. But some businesses may have that leeway of selling various, quality of goods. Some that are much cheaper than others, and so if they get an allowance, they'll keep it. But either way, they're not paying what they used to pay. So let's say Sock Stereo opens up the box and says, look, we don't need this circuit. We don't want this circuit. They send $300 back to PW. Well, they simply record it by reducing accounts payable and reducing inventory. That's all they have to do. Okay, that's all they have to do. It's a relatively simple transaction. They're simply reversing what they did when they bought it. When they bought it, it was a debit to inventory, credit to accounts receivable. If they return anything, whatever portion they returned will need to be reversed out. Accounts payable get the debit, inventory gets the credit, it's reversed out. Okay, so now they're not paying for it and they don't own it. Okay, everything affects inventory. Credit terms are basically when you are buying something on account. And for the most part, here in this invoice, you saw the credit terms 210 net 30. Again, 2% discount if you pay within the first 10 days, 10 days of the invoice date. If not, the whole thing, that's the net amount, is due in 30 days, 30 days from the invoice date. Now, it's advantageous to give people discounts because the purchaser sees it as a way to save money, and the seller sees it as the way to collect cash sooner. And I don't know about you, but I would rather be collecting cash in 10 days than waiting 30 days to collect cash. So this provides an incentive for both. The most common discount you're going to see is 210 net 30. Okay. There are other types of discounts that are available, but this is the one that you're basically going to be seeing over and over again in this book. All right, so let's take a look here at our next illustration. So Sock Stereo, remember they bought $3,800 worth of goods and they sent back $300 worth of goods. So now they have a balance of $3,500. And then this is the 10th day, May 14th. That's the last day. They decide they're going to pay that day. So again, on the 14th, if they pay, they get the discount. So what's the journal entry that Sock Stereo, remember, Sock Stereo is the buyer. What's the journal entry that they're going to make in their books on the 14th? Well, the first thing they're going to do is show that they have paid their accounts payable. The next thing they're going to show is that they paid 2% less. So they cut a check for $34.70. The discount of $70 is the same as saying we paid less for our inventory. That's how we look at it. So the $70 credit will go to inventory, which reflects that we paid less money for inventory. So inventory is one of those interesting accounts for an asset. When we buy it, of course, we debit it to show that it costs that much. If we have to pay for shipping, it costs more. So we debit the account more to show it costs more. But in this case, if we're saving money by taking a discount, we reduce it. And we reduced it by $70 on the credit side. So that's usually how it works for inventory. If they waited until June 3rd, obviously the whole amount, the net amount would be due. And it's a very simple entry. A debit to payable showing we have no more bills that are due, and here a credit to cash showing we paid cash. So it's a relatively simple transaction, and that's the case. And I don't have to worry, I'm not going to show you that part because it's really irrelevant at this time. So that brings us to the end of learning objective 2 with the transaction. The transaction is between De La Hoya Company, who is the buyer, and Juno Diaz Company, which is the seller. Okay. And so we're going to be looking at this from the buyer's perspective. So up September the 5th, De La Hoya Company buys merchandise on account, which means they got an invoice to pay, from Juno Diaz Company. The purchase price of the goods paid is $1,500. Okay. 3 days later, on the 8th of September, De La Hoya has returned goods they think are defective for $200. So now we have to record this in the journal. So the first things first, what happened on the 5th of September for De La Hoya? They're the buyer. Well, they bought some inventory on account. So they're going to debit their inventory by $1,500, credit their accounts payable by $1,500. But 3 days later, they sent $200 of merchandise back. So how do they show that? Well, they're simply going to flip this. All right, that $200 is going to be taken out of the accounts payable, and that $200 is going to be taken out of inventory. And we're done with that piece. Questions on the buyer's side of the transaction. So the next thing we're going to do is we're going to look at the exact same invoice, but now we're looking at it from the seller perspective, PW Audio. How does PW Audio deal with that? Okay, we just looked at how Sock Stereo dealt with it. Now we're going to look at PW. So you're ready for PW. Okay, great. I keep trying, Gio, you know that. All right. Learning objective 3. It's the exact same invoice that we saw in learning objective 2 between PW Audio and Sock Stereo for the exact same merchandise, exact same date and terms. But now we're going to look at it from the seller's perspective. The seller is PW Audio. What do they do on their books? Well, first of all, they just sold a bunch of merchandise. So this $3,800 really is a sale to PW Audio. Okay. Sales can be done 2 ways. If they get paid right away, it's a sale for cash. But in this case, if they gave an invoice with terms, they basically, it's on account or on credit. So they basically sold it to Sock Stereo, gave them this invoice and say, pay me later. So, so the invoice basically is going to show us for PW Audio that it's a sale. If you're PW Audio, you're doing 2 things. You are recording the sale. That's step 1. So you debit, in this case, you're going to debit accounts receivable because you gave them an invoice. If they paid cash, you would debit cash. The second thing you would do is you would record the sales revenue. Remember, this is the debit column. This is the credit column. They're just assuming you kind of get where those numbers go. Okay, so the debit to receivable, credit to cash records the selling price, which was $3,800. But they just sold some of their inventory, which is, of course, that's what they're in business to do. They want to sell their inventory. That's the whole idea of a merchandising company. I have this inventory, I want to sell it. So now they have to record the fact that once they sell inventory, they can expense it. That's what cost of goods sold is. That's an expense account. But they also sold inventory they no longer have. So they have to reduce the amount of inventory, which is an asset account, right? And we've seen this before, right? Debiting the expense account, crediting the asset account is what we were doing last chapter as well, right? With all those adjustments. So here we're simply recording the expense, cost of goods sold, at whatever we paid for it. We look at the cost. It's going to be different than the selling price. And we're going to take that out of inventory with the credit. So let's see how this works. So here is the sale, $3,100 on May 4th to Sock Stereo. We already know that on account. But what we didn't know is that the cost to PW Audio was $2,400. So they bought it for $2,400. That's what it cost them. They sold it for $3,800. This is what retail and merchandising does. Okay. So the first thing we do is record the sale. The second thing we do is record the cost. So here we sold $3,800 worth of stuff to Sock Stereo on account. Accounts receivable got the debit, sales revenue got the credit. Now we have to do step 2, which is the cost. That $2,400 is the cost of goods sold that we can expense. And of course, we just sold our inventory. So the credit to inventory means we have less inventory. Inventory is an asset account, goes down on the credit side. Oops. Well, the flip side of a return is if you sold it, if you get it back, you look at it a little bit differently. You actually set up your own account called Sales, Returns, and Allowances, because it's important to know if you sell stuff for a living, which retailers do, it's extremely important to know what's coming back, because the whole purpose of you selling it is you don't want it back. So if this stuff is coming back to you, it's like, why? What is it? Why? Blah, 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 blah. I'm not in the business of selling stuff just to get it back, right? So having a separate account, Sales, Returns, and Allowances, allows you to keep track of those types of things significantly better. Okay. And it clears a record. So actually, Sales, Returns, and Allowances is a revenue account, is a new account for you, but it has an opposite balance. So it's called a contra revenue account. So sales returns and allowances really will have a debit side balance because, as you know, sales revenue has a credit side balance. So if you got this returned, the first thing you would do is you would debit your sales returns and allowances for the amount of the merchandise that came back. And if it's still good merchandise, you can sell to somebody else, just stick it back in inventory. Stick it back in inventory. So the sales revenue is not affected because we don't want to obscure what we actually sold. We want to actually differentiate between what we sold and what actually came back. And like I said, it's going to matter what comes back, because the chances are if you're a retail store and you keep getting a particular item returned to you after you sell it, you don't want to keep this on the shelf. I'm not going to order any more of this stuff. It's just crap. It just keeps coming back. So it's like, no, you're not going to do it. So it's important to keep a separate record for all of that type of stuff. So that's what happened, right? PW Audio sold a bunch of stuff to Sock Stereo, and look what happened. Sock Stereo sent back $300 worth of circuits. The cost of that was $140 to PW. It's important to assume in this case that the goods were not defective. So the first thing we do is recognize that this is a sales return and allowance by debiting sales returns and allowances and taking it away from our receivable. We are no longer going to be collecting, we're no longer waiting to receive that $300 because it's been returned. Excuse me. It's been returned. And we have to decide, well, can we sell it again? Well, if it's not defective, you can sell it to another customer. So you can stick it back in inventory at the cost, $140, but you have to take it away from cost of goods sold. The interesting thing about cost of goods sold is it's the only expense account that regularly has some credit side activity. As you know, expenses are always on the debit side. Cost of goods sold is that odd one that is always on the debit side, except when something's returned, and that goes on the credit side. So, so you will see this a little bit more active than the other expenses that you've learned about so far. in our world, we don't have a lot of defective goods, but what if something is defective and it gets sent back? I will tell you, when I was at your age, most of your 18, 19, 20, when I was sitting in your seat, roughly anywhere between 3 and 5% of goods that we bought were defective, which meant we had to return them, right? Usually. Um, Today, it's much less than 1%. It's a fraction of 1%. And that's because the manufacturing lines have been highly automated. And as long as we program the robots and machines to do things well, they're going to do things very well. Okay. And thus, the defection rate on products is very, very low overall. Of course, it depends on the type of product. An electric toothbrush has many fewer parts to it to work than an automobile, which has lots and lots of parts. And so, obviously, the more complex the item is, the risks increase in terms of maybe something might be defective. But in general, we live in a very good time where a lot of products are not defective. But if they were defective, PW Audio would not be able to sell it again to another customer. So what they do is they assign a special value to it called the scrap value, and they can make it up. This is an arbitrary number. So I would usually suggest, 19, 29, something odd, so it can stick out in the record that it's defective. And so in this case, they have to, again, say it's a sales return allowance for the amount they sold it to Sock Stereo for. But because it's defective and they're not going to resell it, it has to go back in inventory as to something different, which is the scrap value. So they're simply going to add back a scrap value to inventory as well as cost of goods sold. And that's usually what would happen if it's a defective product. But like I said, over 99% of the time, you're not going to really need to worry about it too much for most products. Remember, we offered them terms. If they paid early, they can take a discount. Well, we sold it to them with those terms. So if they take advantage of that discount and they send us less money, how do we handle that? Well, sales discount is another revenue account with a debit side balance. So you learn a couple of new accounts today. So this basically is another revenue account showing the discounts that we have granted for selling goods. So as you see, the process of determining what your sales is it starts with the original sale, which is sales revenue. Of course, if you get anything back in a return, we shrink sales revenue with sales returns on allowances. Remember, this is a credit side on sales revenue. This is a debit side entry on sales return. Same thing with sales discounts. In this case, they saved $70. So this is going to be a debit side entry showing that it's less. What you really need to know is that when businesses, merchandisers report their income statement, they're going to show their revenue account as net sales. Almost always they do that. And net sales means they started with a revenue figure, they've taken out the returns and allowances, they've taken out the discounts, and this is what they actually were left with. This is something you need to know. This is how you need to know how to do net sales. It's actually quite simple, but this is what you need to know. So in the case that PW Audio received payment from Sock Stereo with that discount, how would PW Audio do that in their accounting records? Well, they would show that all $3,500 of the receivable has indeed been paid. $3,430 in cash. And the $70 discount, right, that $70 difference goes to a debit to sales discounts. So again, your debit side is equal to your credit side as usual. Okay. And that leaves us with our do it exercise number 3. Same two companies, De La Hoya and Juno Diaz Company, except now we're looking at this transaction from Juno Diaz, because they are the seller. So how does the seller look at all of this? Same information, except there's a little extra because the costs are now given to you. So on September the 5th, De La Hoya buys merchandise on account from Juno Diaz. The selling price, as we know, is $1,500. The cost was $800. So 3 days later, on September the 8th, De La Hoya returned the goods for $200, but the cost was $105 to Juno Diaz. So now we have to record all the stuff with Juno Diaz. Well, first things first, what happened on September 5th? They sold $1,500 worth of merchandise to De La Hoya at a cost of $800. So the first thing we do is record the sale. Accounts receivable gets the debit, sales revenue gets the credit. Next thing we do is record the cost. Cost of goods sold was 800. We reduce our inventory by 800. So September 5th is taken care of this way. 3 days later, they returned the goods, $200 of those goods. $105 cost, we assume that they are not defective. So how do we record that if we are the seller? Well, first of all, we're going to show that as a sales return and allowance and remove that amount from our receivables because we're not waiting to receive money on that sale, that part of the sale. And then we're going to stick it back in our inventory because we're assuming it's good. And we're going to take it away from cost of goods sold. And that's that. So we looked at merchandising companies, that business-to-business transaction, because retailers have to buy the goods from other businesses, put it in the store, and then you and I go in and buy the stuff that's there. So they have a cost that they have to keep track of. And then inventory, while it's sitting there on the shelf, is their asset. When we go in and buy that stuff, the prices we pay are the revenue for the company. They subtract out their cost after we buy it from them. They subtract out their cost of goods sold. The difference between price and cost of goods sold is their what's called a gross profit. For the business-to-business transactions, rolling objective 2 looked at it from the buyer's perspective, that invoice. What does the buyer see? How do they record it? Rolling objective 3, same invoice, but how does the seller record it? That's the lesson today. Questions, comments? Staring contest? No, none of those. Okay, I'm going to stop recording for now and